Hey guys, welcome to another Trade Genius podcast. Got my good friend Bob Kudla all the way from Maui. And guys, we're going to talk about interest rates. You need to understand what is going to happen with rates. Are they going to rise? Are they going to fall? We're going to tell you what to expect and what's coming down the pipe later this year. Let's dive in.
Trade Genius.
Okay, Bob. So people have been enjoying nice yield on their savings accounts lately, but that's fine if you got cash. But if you got debt, holy smokes! And it doesn't look like this is going to get any better for those folks that are looking at debt that's going to come up for refinancing here, and especially in the commercial part of the market.
Yeah, I mean, look, we have a situation where the 5 years ago, when a lot of people took on these notes, we had interest rates. They were getting interest rates of 1.5–2% on their loans. 5 years out, a lot of people kept those loans because why wouldn't you, right? You're arbitraging a stock market that was going through the roof, and you're paying 1.5%. But a funny thing happened on the way to 2025. We have now those refis on those notes are going to be at 7.5%, Phil, and people are going to take massive losses on the assets they were using to trade against it. This was like another version of the carry trade that probably has been unspoken. And you're already seeing it happening in real estate. So real estate's pretty much dead. And now you're going to have this situation where these people are going to have to retire the debt, walk away from the debt, or extinguish the debt by closing the assets that they have. And I think that's probably what's going to happen, all three. And we're looking at that July, August timeframe, and we're going to have an ugly fall. Not that February and March haven't been pretty nasty, but I want to show a chart here that should kind of scare you a little bit, because in 2007, 2008, we had the same situation happen. We had a push up in rates. Those rates are unsustainable. And what causes the rates to fall isn't necessarily, good news. They're falling for reasons because the markets were crashing. And we're having the same situation here, even a little bit more volatile, I may add. And you have to understand that the Trump administration, you heard Scott, I think it's Bessert's his name, or Bessent, he wants to force a recession. We talked about that. Biden didn't want a recession. Trump desperately wants a recession because it's going to drive down the cost of borrowing. These tariffs are not just punishment. They're trying to kill demand so that they can justify the lower interest rates. And then they want to lock in lower interest rates to drive the interest rates down on the loans that we're paying, so that it frees him up to do whatever this reimagining of the United States government is going to look like. But they need lower rates, they need lower oil. I think today the Saudis kind of complied with that, and big dump in oil today. I think you have a number around $55 to $40 area. I'm a little bit more optimistic, but still, if Trump can get oil down to $60 a barrel, average of 70 plus, because that's, you're looking at, 11 to 14% reduction in inflation and inputs. And so, we always talked about, Phil, that we're going to be printing negative inflation numbers here come late spring into summer. And I think they're going to come really fast here now. How about the Atlanta Fed lowered their GDP to minus 2.4%?
Yeah.
Guys, if you think Phil and I were Cassandras, all we were is just being realist. And now it's starting to bite. And you know what? And I'll give you the floor in a second, is that the selling really hasn't begun yet. This is just kind of regurgitation of the November election optimism. Wait till they start biting into people's true losses versus, absence of gains. Then you're going to see selling on enormous scale. But I don't think that happens till late summer.
Yeah, I mean, right now it's just looking like, a kind of a deeper pullback, but, a typical pullback that you would see in a bull market. We are now starting to, in our crosshairs, look at the 200-day moving average under the S&P 500, which I think is way, way overdue for a touch. We haven't seen that since basically Q4 of 2023. So I think that's going to come. We'll finally get a bounce off of that. That might be our low for this move, and then we'll bounce up, and then we'll see what happens as we come out of March after that OPEX. There might be a little bit of a relief pop, but then, that's where people are going to start getting hopeful and looking for new all-time highs. I think you're going to probably hear that rhetoric on Twitter. And then basically what's going to end up happening is we're going to probably have a good shot at putting in a lower high. So you could go all the way up to the 786 fib, wherever that is. We'll cover that when we put in a low, and it'll feel really good. It'll feel like things are on the rebound. And in reality, that's a lot of times where that bear market really puts in that signature lower high, and then we roll back over. Defensively, this is where you have to start looking at your 401ks. Those things are real kludgy when it comes to getting defensive. Basically, you're going to have a money market fund option in those. You have to start looking at those now and start thinking about what you're going to do. Do you want to go through a 40-50% drawdown in your 401k, or slide it over into cash, let the forest burn, buy back in 50% lower? Now all of a sudden you've just supercharged your 401k portfolio. So, and it really depends too how much time you have left. Are you working for another 10 years? Are you just getting started in your career? So all of these things matter as well. But this is the kind of time we don't run into these windows very often. We're at a very crucial spot in the market. And then it comes down to, like you said, Bob, rates are going to come down. Why is that what's the catalyst for that? I think it's going to be jobs. They're going to, until they see jobs, I think they have some benchmarks that they have to adhere to with the Fed being as just this huge engine that runs everything policy wise. But I think it's going to come down to jobs. I think that when we get really close to 5%, we're going to start seeing them making all kinds of excuses of why they got to cut. Until then, they're going to try to keep inflation, or we see a pretty decent deflationary move, and it's very obvious that we're back in that core PCE box of 1 to 2% inflation.
Yeah, I totally agree. And remember, guys, we have 2 more weeks of hell here to get through this next OPEX. And then, if you're positioned right, or you're not being greedy right now, and you have dry powder, I think coming out to the end of March, at least for the next 4 to 6 weeks after that, should be pretty easy money on the long side. So just take the deals as they come. We were short, today. We made some good money, and I got out of my short positions, partly because I'm on vacation, but we also filled a gap. And now we'll have to see if we push down in these second gaps that are showing up here. But the market's going to be violent, guys. Look at what happened Friday. The market was dumping all day, and then the last 45 minutes, they just launched it. And that's what's going to happen here. If you can't get complacent either side at this point, but volatility is definitely a friend of Trade Genius. So if you want to trade with us, come on in. We'll show you a really cool trick. If you join the VIP room, there's a real cool trick. The guys they're just absolutely killing it. And we'll share it with you guys. So tradelikeagenius.com. Check out the specials. Phil, thanks for everything. And we'll probably be back at you guys again, maybe on Wednesday. So with that, Phil, thank you.
All right.
Trade Genius.